Energy prices are holding steady this afternoon with WTI just under $90 a barrel and Brent around 93. Oil on pace to record its fourth straight months of gains as well, but with Russia already relaxing its fuel ban announced just last Thursday, and with the Fed widely expected to keep rates higher for longer, will the positive momentum slow? Let's ask Jeff Currie, Goldman Sachs outgoing global head of commodities research. Jeff, first of all, it's great to see you. Welcome back.
Great. Thanks for having me. It's a pleasure to be here. It's my last time at GS head of commodities research.
It's the end of
I retired.
In air, I mean, are we going to see you again in another form, or is this it? You're going out to the ski slopes and we're never going to see you again?
Stay tuned. There'll be a following act, but I am going to try to enjoy those ski slopes along the next 3 to 4 months. So
I can imagine.
But we'll be back. And by the way, I was thinking about, do you know I was on this show in April 2020, the day we went negative. So if I look back, the highlights of the last 27 and a half years was I had the privilege to be talking about prices when they went negative in April of 2020. Actually, it was on this show this time.
Thank you for that. Thank you. And it's been fun to that's why every time I see you, I think about all the extremes that have happened in such a short period of time as well. So we had negative 30 or whatever we did back then. We popped up to 130 last year. But I really thought the best articulation that I really heard of what was going on in the global economy the last several years was you talking about the purchasing power that had shifted from basically the wealthy to everybody else, and the fact that we were just running out of molecules as a result.
Yep. And by the way, those types of pressures on the system, they haven't gone away. So we'll be talking about them for the years to come. So
if I were to say, okay, the last time, that our unfortunate viewers get to hear from you, your parting thought was that we're in a super cycle that still has legs to it, or is it just oil now because of underinvestment and undercapacity and the energy transition, or what's the next kind of 5 to 10 years set us up for?
I mean, it's every commodity out there. In fact, we still stand by the view that copper is the one best positioned over the next year because, copper is the new oil. If you're going to electrify the world, and given all the elements in the periodic table, the only thing that can conduct electricity sufficiently is copper. So strong demand story, and like oil, it's got underinvestment on the supply side. Inventories are low. The only headwind right now is strong dollar in the property market in China. But as we look out into next year and beyond, we still think it's going to go above $10,000 a ton. So we may remain quite positive on the entire complex, and copper is the best position. By the way, oil is just as well positioned, but it just doesn't have as long of legs as
But there's a war on oil, right? No one's declaring war on copper. And there's so many things I wanted to ask you about, but looking at what the UK government is doing, where in the hopes of maybe, shoring up some electoral support, they're walking back some of their major transition plans, while at the same time California is pushing ahead. It wants scope 1, 2, and kind of 3 disclosures down the road. So, I guess I look at something like oil and say, yeah, I can see that the supply is going to be challenged. I look at something like copper and wonder if it's going to be a repeat of the famous Ehrlich-Simon wager where, with commodities, it seems that no matter how much you say there's going to be a shortage, supply always somehow kind of comes up to solve that.
But the difference with copper is it takes decades to bring on supply. Unlike oil with shale patch, you can bring it on in 6 months. But you need capital. And one of the key points we like to say across all these commodities, it's the restriction on capital that creates the problems, not so much the commodity itself. But copper's got a double whammy. Not only is it not getting capital, it takes a really long time to actually produce. But the bottom line, near term, I agree with you, oil's the one with the most upside.
So are we still in a super cycle, broadly speaking, or is that history now?
No, absolutely, it's not history. We firmly stand by that view. You look at the green CapEx that drive it more broadly, it's exceeding all expectation. China's well above where we thought. Copper demand in China is up 11%. Green CapEx demand in China for the first half this year is up 150%. These types of growth rates make the commodities boom of the 2000s look relatively weak. And so when we think about the stimulus that's going to come off of the IRA, Repower EU, when we look out to 2025, this is going to be real demand for commodities, and it'll stimulate oil demand as well. And that's what's really, we're sitting here near $100 a barrel on oil last week. What was driving it is demand exceeding expectations. You're up more than 500,000 barrels per day above even our bullish expectations. So demand is still very much part of the picture across all these commodities.
It wouldn't be a CNBC interview, Jeff, if I didn't ask you for try to really pin you down on your oil price target for the next couple. When are we going over 100? By the way, where's the level of demand destruction? 130, I kind of hear bandied about. Do you want to put a number to that? Have you put that?
Well, econometrically, historically, we'd put it somewhere in that 125, 130, but you got to control for the dollar. And the dollar right now is extraordinarily strong, which actually brings that level down. But if you start to put a weak dollar on it, particularly for other parts of the world, it really gives you room to run to the upside. And so if you think about your starting point, we're sitting here at $93 a barrel with an incredibly strong dollar backdrop. The dollar begins to weaken, it gives you room to run to the upside.
Right, which then...
you got to put it in the context of what's going on the dollar, because that's what triggers it around the rest of the world.
Fair enough, although I imagine the level of the dollars, that's like a hot CS camp kind of, I don't even know if they want to kind of proffer that. So who is it now? Stuyven? Don, do we talk to Don?
Don Stuyven. He's replaced me, and he has a great background in doing this. He's a microeconomist, and he's done some great work on looking at OPEC pricing power, which we think is critical going forward. So the team is incredibly well staffed going forward. You got Nick Snowden on the metal side and Sam Dart on the gas side. So it's in really good hands, and I look forward to reading what they're going to be publishing going forward. I
want to ask you something kind of like a biggest regret or like biggest thing you've learned over just something like that to close us out here.
Do not underestimate the power of liquidity. I look back at these markets, particularly, in the 2000s, we do fundamental analysis, balance tables, and liquidity, as we witnessed last year, when they were draining the market with liquidity, we were all bullish on fundamentals, and this market kept going down. In the 2000s, fundamentals were quite bearish, yet the market kept going up. Why? Because liquidity was driving it. And so if there's anything I can leave, all the listeners to, have a very profound appreciation for dollar liquidity when you think about this in the context of fundamentals.
I love it. It comes back to everything else that we cover here day in and day out.
Yeah,
Jeff,
exactly.
A pleasure. Thank you so much for your time and for joining us
Kelly,
today.
It was a pleasure.
Congrats.
Thank you.
Best wishes.
Thanks.
Jeff Currie, departing Goldman Sachs.